Hi, let's talk about Orphazyme. It's a biopharmaceutical company that develops on therapies for the treatment of neurodegenerative orphan diseases. It's highly volatile share price. It's currently unprofitable, not forecasted to become profitable in the next 3 years. Shareholders have been diluted in the past year. Also, the Snowflake analysis shows 5 out of the 6 on the financial health. Latest share price and event, so they had been a lot of the product updates announced, and also the legal issue was on the latest part of the news. And as it highly volatile share price, I mean this one, highest points in June 10th, $77, and they closed at 21. So that is pretty huge upside there. But might this go parabolic? Never knows. Biopharma Catalyst shows that they have this kind of drug pipeline on followed stages. So this one first serial. So there's a respond letter issue, some kind of in June 18th, and also there's another one on the phase 3, and third one phase 2 out of 3. Trial did not meet primary endpoint. That was on March this year. And yeah, anyway, this is leading to the market performance. So basically they had IPO back in September last year. So this is not showing the 1-year returns. Anyway, 90 days return is minus 4.4. Of course, it's not beating the industry, neither the market. Long-term price volatility, I'm not sure why it's showing beta, because there's no relative volatility compared to the stock market. 5 years needed. But anyway, valuation side, basically simple Wall Street. Neither the tip ranks does not have any price targets, but Market Watch shows on the highest points $19, on the lowest $1. So there's this scale of from 1 to almost 20, on average of 8.59. So actually it might be, if there's possibly good news about the company, about the drug pipeline, about some stage movements and so on, this could lead the stock price for the better prices. But currently I think the level of 10 to 12 is pretty normal, because they had this kind of movement last year. If they dial it too much, if they put shares out too much, it could of course affect on the stock price. But of course it would also make progression in the research stages. Future growth is forecasted 57% annual earning growth. So they have this kind of decreasement in the earnings side. So they are not generating the revenue, but on the earnings, of course, it's if we look at the simple say dividends, yeah. So total sales, they have no sales. So it's a clinical stage biopharmaceutical company that have research going on, and they need all the time the money. And we will be back showing how much cash they have. Earnings per share is forecasted that actually they're not, maybe there's big maybe end of last year's, so they could become profitable. Anyway, past performance, historical annual earning growth decreased by 45%. So there's the earnings decreasing. Actually, this is just the numbers, how much they pay for the research, and currently it's unprofitable. Financial health side, we see here that they have high level of equity, cash, yeah. So it's no problem for them. They have cash, 726 million. I'm not sure, is this kroons or something, because it's not in the dollar currency. But anyway, equity 620 and depth 57 million. Is this, this is Denmark, so headquarters Copenhagen, Denmark. So this is actually the local currency. Balance sheet looks mostly green, and they're not paying dividends on the insider transactions, no volumes. Ownership breakdown: general public holdings 70%, institutions 20, private companies 7, insiders 2.1, public companies 0.3. And I see many of the companies decreasing. Actually, yeah, very many. Only, yeah, this is, I think, the Denmark's kronos, the local currency. But I don't find here, for example, BlackRock or Vanguard. Anyway, as I said, it's highly volatile. Share price, the shares outstanding keep increasing because many of the biotech companies put just the shares out rather than take debt, which is more better way for the company, but of course it's not so good for the shareholders because it's diluting their shares. We see here that the 1 year frame return is minus 37%, basically since the beginning of the IPO. So investing.com, summary the stock for long-term investors as a sell, and we see here fresh comments: buy this now, thank me later, when should you hit a 20. Of course, it's not financial advice, and be aware of some of the pump and dump stocks like this one. So in big companies, there's no, of course it's possible, but there's no way they could like previous day, June 9, open 530, lowest point 520, and the next day 77 at the highest points. So that's pretty huge. So those who invested in the previous day could at least make 10x's. Yeah, maybe more. Actually, it's like 14 or something. 50, 60, yeah, 14 times. And yeah, investing.com, summary the stock for long-term investors as a sell. Moving average, we see sell, and also technical indicators sell as well. This looks like trap to me. Careful, guys. This comes be issue. Any predictions? As far as I see my chart, there's a big gap to close at 1291. Never say never. I only have until 20th. What's a good day to hold for? So yeah, don't speculate. It's better to invest in if your risk take abilities allows you, go ahead. No more than 1% of your portfolio. Try to diversify it. But anyway, try to start with this kind of companies. Maybe you prefer better on the dividend strategy, or lower dividends but very high growth, for example Visa, MasterCard. And of course all begins from the strategy side. If your strategy is more on the dividend side, so I prefer this side. This is very good side to the comparing the stocks. So you can open the screener, for example, and just define your strategy. And also this Finviz shows also the screeners, so similar as the simple save dividends. So you could possibly take the index. If your strategy is on the dividends, go ahead, put, but don't change the dividends, because here's the explanation, I think the best one. So dividend yield, chasing yield is risky. especially in today's low interest rate environment, while real estate investment trust and master limited partners can offer higher yields. 5% is about the upper limit for what's safe in today's market. So basically, those companies with high dividend yield, they might cut the dividends. For example, AT&T had this one, so they had it on the half. Or they can stop the dividends, but mostly they're reducing, for example, on the 30%, 50%. So they cut the dividends, but mostly they are decreasing. So if your strategy is on the dividend yield, and there's one also good, for example, if we take 3 to 5.5, dividend growth streak 10 plus years, dividend safety over 60, and also check the market cap. So I would not prefer in very small cap companies because they are highly volatile. I prefer even take this one off. And also there's the growth of the dividends. So do I find here, for example, or is it here? Dividend growth streak, but I think this kind of chart shows, yeah. So there's one of the, this is of course not recommendation for the invest. I just show that last year they increased 23%, last 5 years 10%. Of course, okay, this is last 20 years 6% on average. But anyway, this kind of dividend growth, many doesn't say that this is, I think, the most important, because some of the companies increased by 50%, even 100 is possible. So define your strategy, try to invest, or so there's actually on to two sides. So rather than it's growth stock, they just put all the profit money to the research, new innovation, or there's a dividend stocks that are pumping just profits and share with the shareholders. So usually growth stocks might perform better, but never knows. P/E ratio is also one sector, so try to diversify by market cap, by sector, by P/E ratio, by time. Here's the 5-year dividend growth. So basically, those kind of companies perform much better. So this is one of the tools that you can use to define your strategy, and this one is also a good screener. Anyway, thanks for watching my video. Subscribe to the channel, like the video, and see you in the future one.